welcome to this very special show. It's that time of the year when we take stock of the year that's gone by, take stock of the hits, think about the misses, but also think about the year ahead. Coming into 2012, nobody really thought, at least I don't remember anybody saying that it's going to be a great year for stock markets, or actually for any asset class for that matter. It's turned out to be a great year for stock markets, and a better year compared to 2011 for most other asset classes. How's 2013 going to pan out? That's the focus of this show here. With me is Ajay Srinivasan, CEO, Financial Services at the Aditya Birla Group, joining me to take some questions. Ajay, thanks very much for your time.
Thanks, Prashant.
Great to have you here.
Thank you.
Broadly, as we head into 2013, what are your thoughts? 2012 has been good and great in some cases.
Yeah, so I think 2013 is really going to be, in many ways, the bottoming out of many things and the kind of beginning of a turnaround. I think whether you look at in terms of economies around the world, I think you're going to start seeing, the bottoming out working there. I think the markets have clearly bottomed out. I think sentiment has bottomed out. So in many ways, I think you've probably formed the bottom in 2012, and 2013 hopefully should be a step up from there.
We're calling it from roller coaster to escalator. Would it really be an escalator move in 2013?
Well, given the markets did reasonably well in 2012, I think your roller coaster is already on an up. So your escalator is going to take it pretty much higher then.
Is it a fast escalator or is it a slow one?
Yeah, I think the slope of the escalator is going to be, definitely slower than what you've seen in 2012. I think the gains in 2012, like you said, the opening were clearly more than people expected it to be. I think really in anticipation of what is going to happen going forward, because you look at anything, you look at earnings downgrades, I think they've slowed. You look at rating downgrades, they've slowed. You look at the forecast for GDP, I think they've kind of bottomed out. So I think in anticipation of this bottoming out and things kind of improving, you've seen a huge inflow of money coming in. That's what's driven markets going forward.
But the real excitement started in the second half of the year, right?
Yes.
September, a lot of announcements came from the government.
Yeah.
And then there was some follow through. Parliament cleared a couple of these things which
Yes.
were announced.
Yeah.
But if you think about it and take the whole year as such, money was coming even before September. The FI number was a big positive even before September.
True.
And then inflows picked up pace from there on.
Yes, I think it was the pace of inflows really that obviously led to the market. I think the policy actions clearly added to to the attractiveness of the market. I think if India grows at 6% next year, which is what many people anticipate, that would be a fairly strong growth in a relative sense in a world that's growing 2.5–3%. So the relative growth, I think the fact that reform is back on the agenda, the government is has pushed through some interesting reform already. I think all of that kind of adds to the attraction of the story.
Along with, as you said, a lot of things bottoming out, I think expectations have also in a way maybe peaked off, right? 2010, 2011, we were all exclaiming, oh my God, 6.5%, 7%.
Yes.
I think people have adjusted to that kind of reality.
I think so. I think that's why, and that's why sentiment is kind of bottomed out, because you kind of adjust to the reality, you realize where you're at, and then you start seeing that things are, kind of bottoming out and getting better, and that definitely helps the situation.
Let's just talk about flows, right? That's basically been the big, huge underpinning behind everything. Most asset classes, stock markets, of course, you get day-to-day prices, so it gets talked about the most. What do you think happened? Why did so much money come in? And this in a year where there have been no upgrades in growth estimates or earnings earnings estimates, etc., right? Things maybe are just about bottoming out now, but India has got some $22–23 billion in flows, portfolio flows.
Yeah. So I think you look at it in the context of what's happening globally, Prashant. I think the big theme has really been huge liquidity across the globe. Across the globe, you have very benign monetary policy and a huge inflow of liquidity, whether you look at the US or the euro. I think in that context, when you look at 22 billion, actually it's a small number. It has a big impact on our markets, but 22 billion in that market is, in that context.
Ajay, I looked at emerging markets, Asian emerging markets, and India and Korea basically accounted for about 75% of the total.
Yes.
Inflows into the markets. That's huge.
It is. It's also a factor of the size of these markets, because if you look at the relative size of Asian markets, these would be amongst the larger markets. Also, I think like I was saying earlier, I think what these inflows are looking at is you can put 22 billion in now. Where do we see the maximum chance of a bottoming out and a turnaround? And India would stand a reasonable chance over there, because like I said, everything kind of looking like it is bottoming out, and the sign from the government on reform, the signs that we're seeing in terms of inflation, the signs you're seeing in terms of some of the GDP numbers, all of that suggesting that you could see the turnaround next year. So this money is coming in advance of all of that.
I'll get to that, the impact of the strong outperformance and strong flows into 2013 in a bit. But I just want to ask you, are you sure things are bottoming out? I mean, inflation is still at 9.9% if you look at CPI. I mean, growth numbers are still pretty disappointing.
But if you look at core inflation, Prashant, I think core inflation is definitely coming under control. There's typically a lag between CPI and core inflation. So we should see consumer inflation coming down as well with core inflation. So my sense is you are seeing some stabilization of the inflation numbers, and that gives some confidence in terms of what could happen with easing going forward. And in terms of GDP, I think things had fallen, but they don't seem to be falling, at least going forward. So I would say that I would see the bottom being formed in both.
I mean, is it possible that through the course of 2013 we continue to form the bottom? It takes that long?
That's
and
possible.
Only sometime in 2014 does the uptick start?
That's possible on GDP growth for sure, especially because for GDP growth to come back to a level that we are comfortable with, you need to get the investment cycle to kickstart again. That's not going to happen so easily and so quickly. That is going to take some time to happen. But the joker in the pack, as it were, in that case is really not the number of stalled projects we have. Because if you look at the number of projects that have been stalled for various approvals, that's a fairly significant number. So if you can kickstart some of those, then you could see an uptick in GDP faster than a normal investment cycle kicking off.
And the government is doing a fair bit to sort of help those things along, right? I mean, NIB, the CCI,
certainly,
and
certainly.
those things. But it'll take time, I guess.
It will take time. It will take time. So you are going to.
You look at the metals and mining industry, for example. I guess things have only gotten worse from the first time the Prime Minister spoke about the NIB. I mean, in various things like iron ore, even coal for that matter.
Yeah, but even a slight uptick in growth is still a good sign, given we've seen the deceleration in growth over the last year and a half, 2 years. So even that is a good enough sign for the fact that there is a bottom. Like you say, we don't know how long that bottom will last, but the fact that you've made a bottom is not a bad place to be.
What is your sense? What are investor expectations? Would people get frustrated very quickly if growth doesn't rebound and we continue to make a bottom on some of these variables through 2013? Would frustration set in very fast?
I think people will be looking for signals in terms of where it's going rather than the near-term numbers, Prashant. I think that's what's happened this year with the flows. People are looking forward. I think even next year you're going to see people looking forward to get a sense of what the trends are. So they may not be so focused on the near-term numbers, though that will guide some of the thinking, but more the direction as to where is this going. You'll have a budget early next year, which will again give you a sense of the way the government's looking at the next fiscal. All of that will be looked at quite closely, I think, to get a sense of how things might pan out.
Do you think it possible with $23 billion and 30% stock market returns, both these things will act against the Indian market as we head into 2013? Because one thing which might explain these very strong flows was the relative underweight position of global funds, etc., on India. That is now reversed. China was a huge underperformer. On the last 2 weeks that started to perform. So China might be the India of 2013. Is it possible?
No, that's a very good question, and it's the right question to ask, because with the structure of flows that we've seen and our structure of our markets, where we are so dependent on foreign flows for the kind of returns we've seen, we are very much competing on a global scale, or at least in an emerging market scale, for these monies. So we will have to compete with the Chinas, the Indonesias, and the Koreas that you mentioned to continue to be an attractive destination. That's where I think it will be important to continue to see reform, continue to see the uptick in GDP. But I think the other countervailing factor to that could be just retail flows, because retail flows have been fairly damp during the course of 2012. Much of the returns have come, as you said, from foreign flows. So whether retail flows can kickstart or domestic flows can kickstart, that could be a countervailing force to foreign flows.
Where is all the retail money going? Is it going in fixed deposits? Is it going in real estate?
So I think what we've seen over the last couple of years is, I think you've seen physical savings actually increasing relative to financial savings, and that's partly, I think, probably a factor of a couple of things. at one level you've seen high inflation and therefore real rates have been under some pressure, and when that happens I think investors are reacting like you'd expect them to, which is looking for assets that give them protection against that, and that has typically been gold and real estate, and you've seen a fairly significant increase in exposure to both those classes over the recent past, and financial savings have taken a beating. I think as inflation stabilizes, as you start seeing real returns increasing, hopefully you should start seeing money coming back into financial assets. So I think that's that's at one level what we are seeing. On the other hand, what we've seen at least over last year is, if you look at retail and institutional flows, and I take mutual funds for instance, I think institutional flows have been fairly robust in mutual funds over the course of 2012.
But I think retail is still pulling.
Retail is there. I think you're seeing retail flows, especially we've seen, for instance, in fixed income, good retail flows. Equity flows have been fairly muted, but on fixed income we are continuing to see flows with people who are willing to take slightly longer term views on interest rates.
But I think that should also start to change once the RBI starts dropping rates.
That should change. So you will start seeing gains in fixed income funds if that happens. So you should therefore see some attraction there. That should have an impact on equity markets if interest rates start coming down. So you should therefore start seeing more retail participation in there. But that's an important thing to look at. It's not just what we do relative to other markets, because that will drive FII flows, but what we do internally to get retail flows back into the market.
You think it'll be a year when retail comes back to the marketplace?
I certainly hope so, because I think retail has stayed out of a lot of financial instruments over the last year and a half. So I think if you start seeing, like we said, real rates getting to be positive and some sense of the economy turning up, I think you will start seeing money coming back.
Actually, if you think about it, I don't think retail has come back after the last crash, which is now 2008-2009.
You're right. You haven't had a big surge, and if you take, say, the stock market and you look at volumes continue to be fairly low if you look at just retail delivery based volumes. So yeah, in a fairly broad range of asset classes, retail has been on the fringes.
The one assumption that I think most are making, so I can just say maybe the consensus is making, is that interest rates will drop in 2013. I mean, some are saying could drop 50, 75, 100 basis points, but they will come off. Where do you stand on that?
Yeah, it's consistent with my view on inflation, and therefore I believe that interest rates will probably come off 75 basis points, maybe a little bit more than that over the course of the year, and that's driven by my view on inflation kind of coming under some control. If you look at the good news from our perspective is, in spite of this global liquidity, commodity prices actually haven't really taken off, and commodity prices have a fairly significant correlation with
inflation. They're starting to over the last couple of weeks. I mean, base metal prices are
but I mean it's marginal relative again to the volume of liquidity we're seeing, and that has a significant impact on inflation again from our perspective. So as long as I think you continue to see that playing out, inflation should be under some control, and that should give the RBI some room to look at easing.
75 basis points through the course of the year.
That's right.
Starting in Jan.
That's right.
I mean, that should help. That should certainly help.
I think it should help, and I think that should help in a number of ways, like we said.
Lower rates could be the tailwind, and some say politics could be the headwind, the big one, with of course the budget, the 2013 budget. What do you think will happen there? Would you think the budget is going to be presented with an eye on 2014 elections, or it's not going to be that way? It's going to be a good budget, fiscally prudent budget, because the government's still scared of a rating downgrade.
Yeah, I think fiscal prudence and consolidation will obviously be an important area, because there are a number of constituents watching that space. But I think there are elections in 2014, and you have to be realistic about what the budget of 2013 will be in that context. But more globally, from a political perspective, I think the stability in the US now, with Obama back in a second term, means that you'll continue with the policies of Bernanke, which I think is supportive for asset prices in general. I think in the Eurozone with Merkel and the elections in Germany, I think again you will see the need to kind of keep a status quo so that nothing kind of goes off track. So I don't think you'll see any negative surprises coming up in the euro, which I think is a good sign again for global markets. So, back to your theme of 2013, I think both of these kind of make for probably a more stable political environment.
Global political environment.
Yes.
What about India?
No, so I think both of that has an impact on our markets. I think in India, I think everybody knows 2014 elections will be due. They will be clearly looking at what happens in the budget.
Do you think there will be early elections, Ajay? I mean,
Not-
in 2013, late 2013 maybe?
Not from what I'm seeing today, no.
You don't think that? And so yeah, just to come back to the budget, I mean our budget here, 2013. How do you think that will go? Would it be a populist one with lots of sops, or do you think it'll be
It's difficult
a prudent one?
to call, Prashant. I think obviously there will be an eye on the election, so I think we'll be naive to expect that there wouldn't be anything as a result of that. But I think there will be several pro-growth measures in place, and I think the pace of reform, in my view, will continue.
Do you think this rally in markets which started, I'm talking about stock markets now, which started sometime in September, and the bulk of gains has come after that, after reform announcements, etc., would stall somewhere in February, March, I mean around the time the budget is presented, and then it's going to be just basically consolidation, sideways market till you get, basically till the time you get the 2014 verdict. Is that possible?
I mean, it's difficult to call shapes of markets so much in advance, but I think you will probably see some expectation running up to the budget. So you could see some continuation of momentum, till the budget. And then it really depends on how the budget, pans out, to see how things will work out past that. I think it's a little too early to call the shape for the rest of the year.
What are the other factors that you think will influence, asset classes in 2013? We've spoken about interest rates, politics.
So I think liquidity, I think politics, I think in some sense the whole geopolitical scenario, Prashant. I think the whole situation in Iran, the situation in the Middle East. I think there are obviously some tensions around that, and I think that could have some impact on on markets as well as we go forward. Especially if there's an impact on oil, what that does to India. So I think we should keep an eye on the geopolitical scenario. We should keep an eye on the fact there is very supportive liquidity environment, and I think globally a fairly supportive political environment.
I just want to talk about this global liquidity. I mean, that's essentially what is underpinning everything right now. I mean, Bank of Japan is in a way joined the party with the new government in place. Fed is printing, ECB is easing. It's almost as if we're in an unreal environment. I mean, printing somewhere is affecting asset prices here. Yes. I mean, take the Mumbai real estate market, for example. I mean, it's going nuts. Well, what's your sense? I mean,
so I'm not sure whether there's a direct correlation between the global liquidity and the Mumbai real estate prices, but I think the whole liquidity thing is really to make sure that asset prices stay high, so you create a wealth effect, and that allows people to start spending again. I mean, that's really the counter to squeezing hard on austerity, which is what some countries in Europe have tried to do. So it is a very different approach. It's not an approach I think we've seen at this scale ever in the world before. So it is different to what we've seen before.
No, I mean, if you take that one step forward, essentially the conclusion is that drawdowns in asset prices will be very brief. They might be sharp, but they will be short-lived, and markets will bounce right back because money is being printed.
True, I think
it's going to be printed for.
And then that's really what we can see in the near term. I think what you need to think about is what happens if inflation comes back, and then what happens if money supply starts getting contracted. Then what happens to asset bubbles that will inevitably get created as a result of this liquidity flow. I think that's a really that's a bigger question. I think in the interim, otherwise, what you are seeing is very supportive liquidity. You will see bouts of volatility as money moves from one asset class to another, but by and large, it's supportive of asset price inflation.
What are your views about real estate? I know it's a very fragmented market, can't really talk about, everything in one shot, but what's your sense?
Yeah, I don't think it's one market, and I think, like you say, there's the differences in terms of cities. There's difference obviously between commercial real estate and residential, and there is a difference in terms of price points, very clear difference in terms of price points. So at the underlying level, I think we continue to see and hear about fairly significant demand if you look at the mid level of the market, as it were, and across the different towns that we cover, we continue to see reasonably good growth, and you can see that in a number of the housing finance companies and the kind of growth they are seeing in housing demand. At the top end, and maybe in some areas in terms of commercial estate, there is clearly oversupply.
Gold. What's your sense? Gold prices.
So my sense is gold is related to two things. It's linked one level to what happens to inflation. And that's driven some of it, but it's also in many ways a safe haven. So if there continues to remain uncertainty and volatility in the world, gold is always a safe haven investment. So if the world becomes a little less volatile, a little less unpredictable, and if inflation comes down, then you should see gold prices coming off.
Let's talk about your group, Ajay. I mean, what's going on? What are you sort of mapping out for 2013? What do you want to do? I mean, I'm sure you want to talk about the banking license, potential banking license, because you've been spoken about as one of the potential candidates for that, with the bill being cleared now.
So we're a fairly significant non-bank, Prashant. We are pretty much present in the entire spectrum other than in banking products. So we're a large life insurance player, we're a large asset manager, we're a private equity player, we're in the lending space, we're in general insurance broking, wealth management, retail broking, pretty much the entire spectrum. I think what we've seen over the last year and a half, 2 years is pretty consistent with what we've seen in the rest of the market, which is that fee-based businesses have faced some headwinds in terms of growth of top line. Fund-based businesses, on the contrary, have done reasonably well. So our lending business has grown actually reasonably well over the course of 2012. We've seen some headwinds in life insurance along with the rest of the industry. Mutual funds have done reasonably well. I think there will be some things to watch out for in 2013. There could be changes in the bank assurance guidelines in insurance. That could change the way distribution works in the life insurance space. I think this whole push in terms of growing the bottom 15 cities in the mutual fund space, I think that could be interesting to see how that distribution pans out, because mutual fund distribution had got fairly concentrated, and I think the regulator was keen to kind of grow the spread of mutual funds, and the policy has been supportive of that. So I think that will lead to some changes over there. So we see continued growth in our business. I think there will be moves within the segments, but it will broadly, I think we continue to see growth.
What about the banking?
Yeah, so I mean, the passage of the banking amendment bill has clearly paved the way for the final guidelines. I think that will come post the RBI, post the Rajya Sabha passing the bill. I guess once we see that and we get a sense of what the final guidelines look like, we'll decide how to.
But how is the space going to evolve from here? I mean, in terms of the number of players, opportunities. I mean, India is still a big unbanked country.
Yes.
But are there enough areas for very profitable growth? I mean, geographically speaking.
Yeah, so I think geographically speaking, there's, like you say, there are large unbanked districts. If you look at our banking sector relative to the size of the economy, I think it is a fairly small sector relative to GDP and economy compared to many other markets in the world. So you should believe, therefore, that there is adequate scope for banking as a segment to continue to grow. I think there will have to be innovation, because as you start getting into smaller towns, as you start getting into unbanked districts, you will have to try different ways of reaching those markets. Maybe it's technology becomes much more important in terms of how you can reach and how you can continue to maintain margins as you reach those areas.
What you're saying is what works in Delhi and Mumbai may not work in some other part of the country.
Yeah, I think brick and mortar may not work everywhere, and therefore you may have to look at other forms of technology to be able to reach unbanked areas. I think the whole internet boom in India, I think, is a very enabling trend that we are seeing over here, because much as we saw in the telecom space, a huge increase in subscriber base, with the huge growth of internet now, I think that opens up many technology opportunities for financial services as well.
Ajay, thanks very much for your time. Great to have you with us here. Wish all of you a very happy New Year from the entire team here at NDTV.
And the same to you, Prashant. Thank you.